I'm waiting 1 second because Xavier is about to come on stage. And unfortunately, Guillaume cannot come today. He's sick, so he's going to be missing this panel. To Mike, yeah. Hello, everyone. Thank you very much for staying until this last panel. So we're speaking about enterprise and blockchain adoption. And I think this is quite a great panel because we have here today only people that have a TradFi background, right? So maybe we can start by introducing yourself and tell us why you changed and why you switched from a traditional finance industry to actually starting building on blockchain.
Oh, wow. That was a long time ago. I was a trader at Goldman Sachs in the interest rates division. And in 2014, the interest rates market was not doing so hot at all. So I didn't think I was going to get paid a good bonus. And I didn't think I had a great future there. I wasn't also very good, to be perfectly honest. And on the side, I had been trading Bitcoin electronically since 2013. And the market was starting to recover after one of the many hacks of Mt. Gox at the time. And I decided to take my ball and leave and start to trade Bitcoin full-time, early 2015. And yeah, never looked back. They tried to convince me I was making a terrible mistake. In fact, it was the other way around.
And don't hesitate to introduce yourself before, just so everyone knows who you are.
Okay, no. Hi, Thomas. I'm from Assetera. I'm the founder and the CEO. And I was pushed into a blockchain first and then moving on by getting securities on chain. I have been in banking for 20 years. I then launched a digital bank, which we sold 2018. And then blockchain came, VC, PE activities, till we actually said, the ICO hype was done at that time, 2019, and we thought crypto as itself is a super success story on chain, but the next big thing is going to put financial instruments on chain. This was actually 2019, and it's actually 5 years later. We are still in early days, and yeah, I guess still the next 5 years we need to build on having a capital market fully on chain with all the necessary regulation, technology, the functions and the market, and what we had earlier in the panels, the liquidity, the user interfaces are certainly something which you cannot build on blockchain. However, over everything which is the underlying, like the license and technology, we build on chain. We are running on Polygon blockchain. We have 2 licenses which are notified throughout Europe. And we allow our customers, institutional clients and retail clients to actually invest and trade securities on chain.
Hi everybody, Xavier Gomez. I'm former banker from Credit Suisse and Pictet. One part of my career was as a trader, as algorithmic trader. And after I moved on wealth management to Pictet. And I decided to jump on the dark side of entrepreneurship to create my own fintech on the data. And now my relation with the subject of the today, I consider clearly the tokenization and blockchain and crypto a new change for the traditional finance. And I decided to create a cross-chain aggregator, Muwpay.
Thank you. So I think one of the first best example of integrating real-world assets into the blockchain space was BlackRock and the Beetle token last year. So we've seen for the past month, right, a lot of use cases scaling on the cash side of real-world assets. What do you see today? Where do you see actually adoption taking off? And are all real-world assets treating equal today?
Well, Clarisse, you told me before we came here that every panel today was the same and that we needed to be a little bit different. I'll try to be a bit negative then. You mentioned Beetle. I checked yesterday. They have $650 million under management. in the summer, in July, it was also $600 million. So it's not grown. That's not very good. And 650 anyway is pretty tiny. I think that we were hoping 2 years ago when tokenization started to take hold that the market would be much bigger, because the benchmark was the funding market in crypto before 3 Arrows. That's when Genesis Trading was still around, and they were number one. My company, I think, was number 3, B2C2. And in total, when you added everything up, you were looking at something like 30, $40 billion perhaps in total funding AUM, I would say. And so everyone thought, okay, well, this stuff is credit risky. So surely, if we roll out risk-free products like BIDL, it's going to be even bigger than that. So that was the one metric. And the second one was, let's look at total stablecoin in issuance. And I think now we're looking at something like $200 billion. And we thought, okay, you would be crazy to leave your cash in Tether or USDC earning 0 at a time when, after the Ukraine war, interest rates went back up to 5% in the US. And surely, $100 billion times 5%, that's $5 billion a year. We thought their gain is our loss, their gain is our opportunity. Fast forward 2 years later, and there's still $100 billion in Tether, so clearly our logic was partially flawed. So I would say overall that when you look at the market for tokenized treasuries or money market funds on chain, it's about $2 billion now, and yeah, that's not so good. I would have thought we would be at something like $20 billion right now. The questions, I think we have to ask ourselves why. There may be many reasons. I will just offer one. I think that especially when it comes to Tether, the kind of people who hold Tether are not necessarily sharing our life circumstances, especially if you consider that the vast majority of Tether is on the Tron blockchain, which is very, let's say, China-centric, very low fee, actually has high usage, so people use it to make payments. But then you have to consider that those people, they don't care so much that they're missing out on 4.5% a year in yield. What matters to them first and foremost is that their money is in the US dollar, outside of the purview of the state, and certainly not in a currency, that's not the case in China, but let's take Turkey, that depreciates 20% every year.
Your question was all about the use cases, right? So what kind of... today in the morning we heard about do 1 or 2 use cases and get deep liquidity in order to pilot, but we are piloting the last 5 years. I guess potentially we have done proof of concepts the last 5 years ago. Now we are piloting that a client can onboard easily, buy a token, either has it on custody with the provider as self-custody. What we see is basically from the institutional side, which is highly demanded, or at least driven to get these tokenized securities into the market, like the money market funds. We have many of those, I mean, US, Europe, you can name that. All of them are super curious about having money markets tokenized. It has a benefit for the investor. On the other hand, it's good to have those projects because then institutional clients can understand what it means in terms of being an issuer on the one hand side, as well as on the demand side being a buyer. On the other hand, we see the second big part of securities is private debt instruments. Any kind of issuer like a real estate project or other projects where you have bonds, most probably, or participation rights, which are tokenized and then distributed and bring on the market. Overall, we are not so much as a company in stablecoin, but we do use stablecoins as a settlement currency for our securities on chain. So you have a pair either in USDC or EURE, which we're using in terms of buying these securities on-chain through our platform.
Xavier, do you want to touch base as well on the subject of use cases?
Yeah, it's fascinating when you have a financial innovation because what I expected, it's not the tokenization of the mutual funds first. In particular, at the moment, all the FOMO with the product launched by BlackRock, Build, and so on. I expected more on real assets, in particular in emerging market, regarding commodities, real estate. It's a transition step in order to educate people, in particular enterprise, because the problem with the enterprise and financial sector, they need a trust, because most of them in traditional finance don't understand very well how it works. You and I, we work with this kind of financial enterprise, banks, insurance. There are some difficulties to understand, but they understand what is a real asset in terms of coverage and so on. And at the moment, I see a lot of projects regarding commodities and real estate, in particular commodities for in Asia and Africa, regarding diamonds, regarding petrols, oil, sorry, because some countries has some problem with US dollar and the current government, and they want to bypass the SWIFT system also. It's more or less a tool to gain in terms of independence, clearly.
Okay, so go ahead.
Can I add here, it's also important what kind of investor you're serving. Meaning a retail investor, what we heard earlier, is potentially looking after some Bitcoin gains over the next 2 months and sell 20% plus. On the other hand, the traditional investor is looking for 3-year, 5% income every year. But what we also see is new product designs, meaning on the one hand you have the security, on the other hand you have, for example, a tokenized BlackRock fund which brings you 4.55%, and then these proceeds are on a daily basis invested directly into Bitcoin. So you're going to potentially have a 7-8% on a yearly basis, and that's again interesting for those crypto investors who potentially are redirecting 20% of their portfolio, so that this actually gets filled up and more liquidity comes into securities on chain.
So what I understand from what you're saying is that, first of all, there's some not misrepresentation, but so we thought that potentially we were going to be able to create yield on the money trapped on chain. Turns out, not working so much. We're looking for other use cases building utility, and we see that when actually you're killing some pain, meaning wanting to hedge a currency that is actually volatile, having being paid in USDC or putting your money in USDC makes some sense, and then getting the yield there is also making some sense. There's some other asset classes that have been tried to be tokenized for the past 3-4 years without success. For instance, bonds, and we've seen a lot of big banks trying to put POCs out there on tokenizing bonds for large corporate or even large non-governmental entities. What's your take on the bond market and on the tokenized bonds as a potential new wave of adoption on the RWA side?
Well, you've got really two markets here. On the one hand, there's us, crypto, the crypto market. And on the other side, there's the institutional fixed income market. They have nothing to do with one another. Now, one thing that's positive when it comes to bond and blockchain or crypto is to take some legal frameworks, concepts, etc., ideas, ways of doing things, bring them into the crypto fold. So one of the most important ideas, very simple one, special purpose vehicles. So crypto companies just created a bunch of special purpose vehicles that issue tokens, and those SPVs purchase actual assets like treasury bills, and that enables you to use a tokenized version of those assets. Great financial innovation that has existed for 30 years in TradFi, more than that actually, and then we brought it into the crypto fold. Now the other way around, there isn't a lot of interesting cross-pollination happening, because every time a large financial institution says that they tokenize something, in reality, all that they do is run a dual-track process where first they issue a normal bond or other kind of asset, the same way they always do, and then on top of it, they slap a crypto sticker and say that they have tokenized it. But typically, and Guillaume could speak to that, but he's not here. Typically what they do is they issue a token on a private blockchain and they deliver it to a custody account of the investor. The investor doesn't even touch the token, but they're able to say, look, we created a token and we delivered it to the investor. But what really matters is that the investor just sent some dollars on an old-style SWIFT IBAN bank account, and they got the asset in return. So it's never the case that you can actually trade the asset. You can't buy the asset. You cannot go on Curve. It's always some kind of club deal between 1, 2, 3 institutions max. And in my view, yeah, the word you can use here is that it's a gimmick. It's a gimmick. And the reason that it's so foreign to what we do in crypto with actual real money is that they refuse to use stablecoins. If they use stablecoins, naturally the asset would be more crypto native, because you could use like atomic swaps, you could put your stuff on Curve. I mean, there's so much, we call them DeFi primitives that come with the fact that every part of the transaction is on chain. When you've got a token, perhaps on a private blockchain, and fiat on the other side, it's not really blockchain. In order for an issuance to be properly digital, it's got to have both the asset leg, the thing that you issue, and the cash leg on chain. And in order to have that, you need to have either stable coins or CBDCs, but that's not something I really believe in.
And just to double down on that, Max, is that how you, so who are you targeting at PV01, right? And how have you built your infrastructure?
We target strictly the crypto ecosystem. We have one deal that we're working on now with a European asset manager who doesn't want to touch stable coins. So we do the same thing that the banks do. They send real dollars, and then we create some kind of vague token, and they don't care if they receive the token or not, as long as they get paid. But our focus is on the crypto market, because I think right now that's where the money is. Of course, I would like to think that in 5-10 years, we're going to be issuing bonds for Tesla against USDC, and the US government is going to have maybe even a GovSwap platform where you can exchange your tokens for government bonds, but at the moment, that's just not where the money is.
And what utility are you bringing to the issuer?
Well, what we bring to the issuer is two things. There's a very old-style drudgery work of making investors and issuers meet. It's not technical at all. It's really old style. We roll up our sleeves and then we go knock on doors and try to create issuances that are of interest to the investors and vice versa. But on top of that, there is the tokenization aspect, which really we try to shoehorn into real DeFi. So if you take our first product, so we have tokenized bond, okay, it's denominated in USDC. Today you can go on Curve and you can buy it. Yeah. So that's really important to us. First, to focus on the crypto market and to focus on deals that naturally integrate with DeFi because they're ERC20 and everything that we're all used to.
So you're building an investment bank for the DeFi market?
Yeah, I mean, that's at least the aspiration.
Thank you very much. We talked, we're trying to see what are the different blockers, right? And why finally, or not, why is it hard for the blockchain technology to enter into the financial institution standards? We talked a lot about, interoperability being an issue, liquidity being fragmented. At the end, we see that there's different model and different business model around tokenization. And I think what's very interesting, Thomas, is that you've developed something that is quite different. So you want to tell us a bit more about the business model here?
First of all, let me say one sentence, what Max said. We see still different models out there. We see banks who are trying to make a pilot, which is a tokenization in turn on gold, which is nothing, and it's not even blockchain. You have still centralized companies or companies who are doing a centralized operation who are doing nothing on the blockchain only after it's in custody. So what I'm saying here is, and earlier we had also a panel saying DeFi might be the only model 10 years down the road or maybe 15 years. I also do believe in DeFi, but we also need to understand that currently on the traditional markets we have all the liquidity, right? And for us it needs to be the combination of a DeFi operating model with a interface customers are used today with potentially the mobile banking, online banking, and on the other hand, kind of link the liquidity of the traditional capital markets. It sounds a bit weird because it's a big, it's combining everything, but we are putting capital markets on blockchain. So it's not something that happens overnight. As we also heard earlier, it will take the next 5 years to have the first scaling. We are building right now, we are early days, and you can see that with almost zero in secondary trading. However, what we built is an automated market maker, kind of Uniswap for securities, meaning that you actually get a quote for a security you want to buy and want to sell by using stablecoins, certainly, because we do believe in stablecoins as a settlement currency for our operations. We do have also the WASP license and in Austria going for the MiCAs. Hopefully by the end of the first quarter we're going to have also the MiCA license to make sure that on the one hand with the MiFID license we can have everything done under securities law, meaning the trading and the settlement, and on the other hand supporting the MiCA license for the operation for the settlement, the clearing and settlement as an atomic swap.
So regulatory has been an issue over the past few years, right, for the adoption of real-world assets at large. We've seen a framework in Europe. There's a framework that will come in the US as well. So we're starting to see some sort of harmonization. Yet banks in France and in Europe have been also active in the past. And I want to kind of ask you a question, Xavier, about your supervisory board member hat at the LUBAC. When banks enter the space, right, and they are trying to change their infrastructure in order to start enabling crypto, start enabling real-world assets, what are the concerns they still have today? What are the risks they're facing, and what are the blockers they're still facing?
From a regulatory perspective?
Mostly from, this is more to introduce the topic, but what are the real questions you're asking in supervisory board?
The first barrier is to convince also the top management and employees to change a century bank in order to move in crypto space, because as you know, you have a lot of regulation when you have a French licensed banking. It's a wall of barrier and problems. And when you go to see the central French bank to say, we want to provide to our client, enterprise client, this kind of service, at the beginning, they are not aware to listen to you. First, convince the regulator. Second, the employees. And after, the board, of course, and to put the money on the table to invest on the new IT infrastructure in order to provide this kind of service for this different type of clients, global clients, such as big enterprise, also crypto client because, as you know, in France it's very challenging to open an account. And Delubac welcome a lot of crypto project as a bank, because when you have a request of a license, the French Security Exchange Commission requests you to have a bank account. It's funny because the banking system doesn't accept crypto companies, but in order to have a VASP, you should have an account. And after, the other subject for us currently is to hiring a lot of tech guys to make the job in intern, and give all the culture of DeFi and blockchain to adapt all the streamline of IT infrastructure with the regulatory stuff. And now we start since 2024. We're hiring 100 people in 2024. We have a big plan to hire around 65 people in 2025, and most of them are tech guys, clearly.
So you see a lot of demand from clients to get access to crypto products, real-world asset products, and you keep on building there. Yeah,
because we make a small error. Last year, we make some promotion about provide enterprise services about blockchain stuff and product, and we get a lot of requests around the different company around Europe. And we need to catch up and work on it. And now it's better in terms of integration and onboarding of enterprise. But clearly, currently, we have a lot of requests on that.
So maybe one last question for your kind of second hat, because you're also the founder of Muwpay. So we talked about liquidity, but we didn't touch about interoperability of the assets, right? Is that really an issue today, and why is it an issue?
Technically, it's not an issue, because when you launch a DeFi protocol, it's outside of MiCA today, MiCA 1. So you can make more or less what you want, except if you integrate fiat, you are in a risk position, clearly. In fact, the cross-chain aggregator we create in order to provide liquidity to the different blockchain with transaction swap, with all for one and one for all, with different wallet, is more for enterprise service. In particular, some crypto liquidity provider or crypto custodian or VC crypto, and also blockchain, in order for them to have a more liquidity on different blockchain to pass their token on Cardano, Hedera, and so on. From my perspective of tech, to answer your question, no. But for regulatory stuff, it's a new world, to be honest.
Thank you. Maybe as a closing remark, do you want to highlight, for Max, I'm not going to say a challenge because you've already highlighted a lot of challenges, so you're going to finish on a positive note, Max. What are you excited about in 2025? What do you think is going to change in the market?
I think that the world, for lack of a better word, is going to shit. And that's very positive for crypto.
Positive, Max, positive.
Yeah, no, but it's very positive for crypto. It's very, very good. Yeah. In fact, I was well known in the past for running the biggest market maker in crypto, but I had no crypto myself. I own zero. And now I've decided actually maybe to get, not a lot, just like a little bit. So if someone like me, a notorious no-coiner, thinks that maybe it's the right time to buy crypto, then maybe there's something there. Yeah. At least positive on that.
Okay, very cool. What about you, Thomas? Mostly on the challenges, so not the positive note now. What are the challenges you want to resolve? The challenge you want to resolve this year?
The challenge is a seamless customer experience on our platform, so that almost anyone, by connecting his wallet, can trade on our platform. with the new products and the new services.
Do you think you have the tools today to be able to create that experience? Is the infrastructure and the blockchain infrastructure now, I would say, mature enough for you to be able to create this type of experience?
Yeah, we have already. It's all about the improvement and getting new design, new services, new options for the customer into the platform. But basically, yes, we have developed the system in-house. It's developed on Polygon chain. We do have backend and blockchain developers, so actually yes, but we are also looking for more developers because it's super important to be on top all of the time.
Thank you. If there's any developer in the room.
No. A quick mass adoption. I think it's one of the big challenge because I don't think this nice period will how did you say? Yeah, this is the subject. So we need to build quickly in order to.
And how do you do that? What do you think can be the driver this year?
The project influence clearly with the big project to convince, in particular, political people to say, hey, we are there. We create jobs. We are ready to pay tax. Don't forget us.
And just maybe one thing. So you think that the institutional adoption can come from actually the mass retail adoption, and that's how it will work.
Yeah. It is the only way. Retail first.
Okay. Cool. Thank you very much, everyone. I think that's the end of the day. Thank you.